Welcome everyone to week 3 of the estate planning workshop, our final workshop. Of course, I'll be available. If you have any questions or if you want to discuss other topics, feel free to reach out to me via email. We're picking up where we left off last week, and last week we got through the various types of trusts and their applications and the different variations of each trust. There's more than the acronyms are, there's more acronyms than I have listed here. There's a few more. One point that I want to make before I start this week's session regarding the Q dot from last week, I double checked it, and I don't know if I mentioned it during the discussion, which is the Q dot, if you recall, is formed when you have a non-resident spouse who's the beneficiary of the trust. And the reason why this trust is set up so that the beneficiary spouse can delay or defer the payment of estate taxes on the death of the citizen, on the U.S. citizen spouse. So the rationale here is that this Q dot has a U.S. trustee, and when distributions are made to the non-U.S. beneficiary of the trust, the surviving spouse, the estate taxes are paid from at the time distributions are made. And those distributions have to be distributions of principal. If they're distributions of income, that's okay. Those don't impact the estate tax. But when principal is distributed, that there's estate taxes due on that. And that's the point I wanted to clarify. So the next topic, or the next question, was the benefits of revocable trusts other than retention of control. And this is fairly straightforward. And in a revocable trust, if you recall the 3 unities, in a trust there's 3 parties. There's the settlor, the trustor, grantor. That's the person that is creating and contributing assets into the trust. There's the trustee who holds the asset in trust for the beneficiary. The trustee has all of these fiduciary duties that they need to comply by, and they're holding the trust for the benefit of the beneficiary, not for their benefit. And then there's the beneficiary, who is the individual that's going to benefit, either receive income or principal distributions from the trust. When a revocable trust is formed, the 3 parties, the settlor, trustor, grantor, the beneficiary, and the trustee and the beneficiary, the 3 parties are the same person. And in a family trust, when there's 2 spouses form the trust, the 3 parties are the spouses combined, if that makes sense. So from a control standpoint, the grantor had control of these assets before the trust was set up, and they have control of the assets afterwards. So nothing has changed from a control perspective. It's the same. The most important benefit of the trust is this probate avoidance. And when somebody dies with assets in their name, and this happens, the asset that it causes the probate process, makes the probate process mandatory, is the ownership of real estate. When an individual owns real estate in their own name and that person dies, transferring that real estate, selling that real estate, or gifting that real estate to somebody else becomes impossible because the owner of the property is dead. So that person cannot sign over a grant deed to transfer that real estate. So that so as a result, the transfer of the real estate requires court intervention to transfer that asset to the proper beneficiaries, to the proper heirs of that individual. So that's the most important asset, and one of the few assets that would create a probate process. If the individual has clothing, for example, there's no title, there's no change. Family members can enter the residence of the individual and take the clothing and donate it. If that person has jewelry or cash that's fungible, easily transferable. But the real estate, because it requires a deed requires a deed to transfer that real estate, it makes it difficult when that individual owner is dead. Another an asset that could create a probate process is financial accounts, a bank account or a securities or an investment account held in the individual person's name. So long as they don't have a beneficiary designation. If they have a beneficiary designation form, the asset, the account, the bank account or the financial account gets transferred fairly easily without much problem, without the need for a probate process and no court intervention. But when there's no beneficiary named on that account and that account is in the name of the deceased individual, then the account is frozen and the financial institution, the bank or the investment house, Merrill Lynch or Fidelity or whoever it is going to require a court order to transfer that asset to the heirs. The heirs can't walk into the bank and say, oh, so-and-so was our father, so-and-so was our mother, give us the funds in this account. The bank's going to say, no, you're not listed as a beneficiary. There's no beneficiary listed on the form. So go to court and get a court order and we'll transfer the assets based on that probate order. There's, to kind of facilitate the probate process, almost every jurisdiction in the United States has an expedited probate process for smaller type of accounts. And probate is usually done at the county level. So there's usually a probate court in each county that deals with the probate matters within that county. In Los Angeles County, if an individual dies with assets that are less than $150,000, no probate is required. So if the assets are more than 150, probate is required, and probate is absolutely required when that person has real estate in their name. And most real estate, most small condominium or a single family residence typically costs or is valued at more than $150,000. So that's where the probate courts get involved. Now, if somebody dies with assets, even bank accounts, with no beneficiary designation form that's less than 150, there's a simpler expedited probate process. There's special forms that get filled out and the beneficiaries are listed on that form and their signatures are collected to smoothen the probate process and make it go faster. Because with real estate, a probate will take somewhere between 9 to 12 months. And if there's dissident beneficiaries, people that are fighting or there's issues or problems, it could take a lot longer than a year. And now with the courts closed, and I heard either yesterday or late last week, an email went out from the supervising judge of the Superior Court that all the courts will remain closed until June 5th. So the earliest courts were open for non-criminal matters is going to be sometime in August, maybe as late as September. So you have to count your 9 to 12 months from there. So it could easily push, probate could easily go into late 2021 for things to be resolved and the assets distributed.
I have a question regarding about the $150,000 threshold. Is that on the
Yes.
state level? Is that on the federal level?
That's,
I don't know if it's common, that threshold is common just for the state of California, or is it for pretty much all the states?
no, this is only, I know for a fact that this is an LA County amount.
Okay.
But if, I believe that it is statewide as well. So if we go to a Northern California county like San Francisco County or Merced or San Joaquin County, it's going to be the same amount.
So that amount that you mentioned is specific to California. And
yes.
then I remember the 9 to 12 months is also specific to California. Not every state has this. Some states only have 3 to 6 months. For example, West Virginia is about 3 to 6 months.
The 9 to 12 months is LA.
Okay, so that's also LA.
Yeah, and I would say it's probably LA and the surrounding counties,
right.
Orange County and all the way down to San Diego. But it's possible that in the middle of the state in Fresno and Northern California, it might be faster. Because there's less population in those counties, less probate proceedings are being filed, so things could move quicker in less populated counties in the middle of the state.
Thank you.
Sure. So another question was posed regarding this reverse gift. What is it? How does it work? And I have an example that we can go over on the next slide. So this reverse gift is codified in Internal Revenue Code section 1014E as in Edward. And this is what this code section says. If we have an individual that gifts an asset to another person, could be a spouse, could be a non-spouse, could be an unrelated person, and receives that property back at the death of the individual who received that property, the recipient, who's the original gift giver, if you will get a step up in basis of that asset to fair market value if the person who they gave the gift to, who in essence returned the gift to them, lives for 1 year and 1 day after that gift. Okay, now this is a rule with multiple parts, and that's why I drafted the example in the following slide to hopefully clarify this rule. Now,
before you go on, could you clarify one thing for me? So reverse gift, is this the same as disclaimer?
No.
No, so there are two different things. I just wanted to make sure everyone is clear.
Absolutely. Okay. Yes, exactly.
Good. Thank you.
So let's look at the example to help clarify these points. I think it'll make it a lot easier. So this is the factual pattern. So we have Abraham owns a single family residence. Abraham acquired it 30, 40 years ago for $75,000. And today, the fair market value of this single family residence is $1.225 million. And Abraham owns it free and clear. Now, he has not used his 11.58 applicable exclusion amount, the estate and gift tax exclusion. He has not used that. All of that is available. And this is a very, very important point, the second bullet. It's important because when Abraham makes this gift that he's going to get back, that's going to be a taxable gift. And we want to make sure that there are no gift taxes to be paid on this gift. It doesn't mean that if he had used up his 11.58 million exclusion, it doesn't work. It does work, but the gift becomes more expensive because Abraham would have to pay gift taxes on this gift. So Abraham gifts his property to his wife Sarah. Okay, and Sarah's very ill and her days are numbered. In her will, Sarah leaves this house to Abraham. And it could be either in the will or in the trust. Okay, so you follow. Abraham gifts it to Sarah. So we have step one is the gift from him to Sarah. And Sarah, via this estate planning document, the will or the trust, leaves the asset to Abraham. If Sarah lives for 1 year and 1 day, Abraham gets the house, but he gets the stepped up cost basis at 1.225 million. But if Sarah dies, does not live for 1 year and 1 day, she lives for 1 year, Abraham gets the house, but his cost basis is 75.
Before you move on, so oftentimes when you gift, especially when someone dies, there's always a threshold of the period of years. So in this case, Abraham can give Sarah any time before that 1 year and 1 day period, and this is still valid for the step-up basis.
Yes.
Okay, so this is like almost like a freebie if someone who is very certain their spouse is going to die soon and basically bet on that. This will basically eliminate quite a bit of estate taxes. Almost.
Because the exemption amount is so high,
right?
The estate tax is not implicated. The play here, the game that's being played, is an income tax game where Abraham, if he sold it for 1.225 million today,
right.
his gain is going to be 1.15 million, and he's going to have to pay capital gains tax on that 1.15 million at about 23.8 for federal, and then the corresponding state income tax rate. In this case, if he gives it to Sarah and Sarah returns it to him via a will or a trust, Abraham basically gets rid of his capital gain, and when he sells it for 1.225 million, the gain is zero.
Okay, so I get the example of husband and wife. There's unlimited transfer, right? You can give that between husband and wife, but if the situation is between parent and child,
yes,
then the estate tax will be kind of entering the picture.
Okay, let me clarify that point. If the gift was made to a child who was ill and the child was going to die, then Abraham would use up, obviously, because it's a completed gift. Let's say it's the gift was made today, and it's because it's a completed gift of a present interest, the gift qualifies for the $15,000 annual exclusion. So Abraham would have to use up 1.2 1.21 million of his 11.58 applicable exclusion amount.
Okay.
And that requires the filing of a gift tax return, Form 709.
Right.
Yes.
Right.
Yeah. Now, either way, in either case, whether Sarah lives to be a year or 1 day or dies within a year, her estate, because she owned the residence at the moment of her death, and the fair market value of that residence is 1.225 million, Sarah's estate is going to include that resident of 1.225 million. But because she has presumably 11.58, she won't have to worry about any estate taxes at her death. So if Sarah does not live for 1 year and 1 day, it's the worst answer because her estate will include the 1.225 million. But Abraham is not going to get a step up. He's going to get the property back, and the cost basis in his hand will be 75.
So this is best used between spouse, pretty much.
The other component to consider is this part right here. Let me do my is it the mouse to do to make marks?
You have to be in the presentation mode.
Oh, I see. Okay, okay, that's okay. That's fine. Yeah. So the other concern is that Abraham could, yeah, this isn't between spouses, so there's more safety, but Sarah could change her mind and not leave the property to Abraham. So that point is very, very important when this planning opportunity. So there's multiple layers here. You have to have the donee survive by year 1 day. Also, you have to make sure that the property is going to the right place. Anne, did you have a question?
Oh, yes. It seems like this is, like you were saying, it's more for if Abraham was then going to sell the house. What if something happened to Abraham before he was able to? For his estate taxes, what would that look like?
Before he was able to? So
yeah, so he still has the house.
If he has the house, then it would be included in his estate. Remember, okay. Your estate includes whatever assets are in your name, or whatever assets you own at the moment of your death. The value of the assets you own at the moment of your death. It also includes your debts that would reduce the value of those assets. But if you have property in your name, that's going to be included in your estate. Yeah. So, okay. The goal here, yeah, there's a couple of kind of latent points, which is Abraham, in the back of his mind, he wants to sell this house sooner rather than later. That's number one. That's why we're doing all these gymnastics here, because at some point soon, Abraham wants to sell it, but doesn't want to pay any capital gains taxes.
So the key here is capital gain taxes pertaining to what you're saying more on the income tax area, not the estate tax area.
Exactly, because the estate tax is so high. At least in this example, it's not implicated, because we're assuming that both of them have their the entire amount that's available to them. Now, in the second part of the example, if she leaves the house to Isaac, their son, but not to Abraham, she leaves it to somebody other than the person who transferred the property to her, it doesn't matter how long she lives. The recipient, Isaac, will get the step up. So this 1 year and 1 day only applies if the property is going back to the original donor, the person who gave the property to this sick, ill person, if you will, or this person who is going to die relatively soon.
Thank you.
Mm-hmm. So the next slide, I have some questions about the generation skipping tax and how it works. This is a really, really challenging and complex area, especially when a generation transfers are made through trusts. So let's spend a little bit of time kind of discussing these rules and how they apply in some certain specific situations. Why was this put in place? And this generation skipping transfer, that's the GST, generation skipping transfer. And there's a tax on it. A lot of people say GST referring to the tax, but the GST is the transfer itself. But there's a tax that's applied. What was happening is a lot of wealthy individuals were transferring assets. They're bypassing their own children and transferring their wealth to their grandchildren. And via that transfer, when that first generation, the child or children generation died, no estate taxes were paid. And Congress believed that a lot of estate taxes were being bypassed by wealthy families, so they put in this generation skipping transfer tax regime to capture some of this and prohibit and make it very expensive and costly for wealthy individuals to skip generations, to transfer their wealth to a generation that is 2 or more generations below them. So in terms of the generations, we have the current generation, which is the generation that has the wealth. We have the first generation, which is the children. And then we have the second generation, which is the grandchildren, and further down from there. So if you want to visualize that, we have the current generation, the first generation below that, and then the second generation are the grandchildren, and then yes. So this was put in place in 1976. It was repealed, and then it came back in the 1986 Tax Act. And what does it mean by generation skipping? It applies in 2 different ways. It's generation skipping by blood when you bypass your children and transfer funds to grandchildren. That's the bypassing a generation related by blood. Or if unrelated, if the recipient is 37.5 years younger than the donor. And I have some examples on this. The $15,000 annual exclusion, the gift tax exclusion, also applies for generation skipping transfers for direct skips. So if a grandfather gives $15,000 to a grandchild, let's say $15,000 in cash as a gift, now an outright gift. The $15,000 is excluded for under the gift tax exclusion, and it is also excluded under the generation skipping transfer exclusion. And I want you to think of the estate and gift tax as one regime and the generation skipping transfer tax as a sibling, but kind of a different tax regime. The amount, the 11.58 exclusion, it's the same amount. It's the same amount, but it's a different exclusion amount. So there's an estate and gift tax exclusion equal to 11.58, and there's a corresponding generation tax exclusion, which is also 11.58. At one time in the 80s and 90s, the amounts were different. So keeping track of these amounts for individuals making gifts was challenging. Separate schedules had to be kept and updated, at least on an annual basis, if and when regular gifts and generation skipping transfer gifts were made.
And can I ask a question?
Sure.
Just to make sure that everyone understands. So, so a wealthy person who can transfer using the estate tax exemption of, let's just say $12 million here in this case.
Yes.
In addition to that, that person can also use the GSTT for another $12 million.
Yes.
Okay.
But they're not combined.
They're not combined. That's right.
Right. So for example, if we have a grandfather who wants to give let's throw out a number, $2 million to a grandchild, they can use, if they have estate and gift tax exclusion of 11.58, they can apply 2 million of that to the gift itself. They can also use the 2 million from the GST exclusion that they have, the 11.58, to that gift.
So they specify that when they file the gift tax return.
Correct.
Basically.
Now, if they only use 2 million of the estate and gift tax exclusion, they would owe GST tax on that gift.
I see. Okay.
So it's more efficient to apply both to a generation skipping transfer at the same time, so that no tax is paid on that gift.
Okay.
And one more question. So if you are skipping more than one generation, so let's say that maybe great granddad is giving some property to great grandchildren.
Grandchild.
Yeah. So in that case, this GST tax only applies once or twice. I think it's once, right? But it doesn't it doesn't make sense if you just think about the rationale, because you want to pay taxes for every generation, right? So if you're skipping multiple generations, I read somewhere that only one GST tax actually will apply. Is that accurate? Is that correct? Or do you know exactly?
So you're saying if there's a generation that's skipped, and then
so there are two generations.
There are two generations, yeah.
Okay, so a grandfather makes a transfer to a grandchild. That grandfather, if they've used up their 11.58 for both the estate and gift and also the GST, and I have an example about that, the numerical calculation will go over, will have to pay gift and GST taxes on that gift.
Mm-hmm.
Do you agree?
Yes.
Okay. Now then the recipient turns around and transfers that gift, skips a generation. Is that what you're talking about? At some point in the future? So here in this chart here, G1 gives it to G3. That's a generation skipping transfer right there. And then G3 transfers the gift to G5.
So I'm asking if G1 gives a gift to G4 or G5. So
Once.
once.
Yes.
Okay.
Yeah, that's right. That's right. Now, I thought in the case where G1 gives it to G3, for example, and then sometime later, G3 gives it to G5. In that case, the G1 pays a generation skipping transfer tax, and then G3 pays another transfer tax, because
Okay.
these two are treated as two separate transfers. But if G1 gives it to G4, then there's only one GST. Yes.
Okay.
Yeah.
All right. Thank you.
Sure. Here I have some examples on the direct skips, where we have a 90-year-old grandfather who makes a gift to a 22-year-old granddaughter. That's a direct skip because we're skipping the child generation. This is the relationship by blood. Now, the 90-year-old grandfather can give the gift to a great-granddaughter, and that would be a skip as well, because we're skipping, even though we're skipping 2 generations, it's still a skip. We're still skipping a generation. The other example with the non-related, we have an 84-year-old person who makes a gift to his college buddy's daughter, and the daughter is 40 years old. So the college friend is about the same age as the 84-year-old making the gift. But because the friend's daughter is older than 37 and a half, or younger than by 37 and a half from the donor, it's treated as a skip. Even though the 84-year-old, if it was making it to his daughter, no matter how young she is, it would not be considered a gift under the blood relationship rule. A similar situation would be when you have 2 spouses that are, or one spouse is older than the other spouse by 37 and a half years. If the 2 individuals are not married, the gift would be a skip. But if the individuals are not married, it wouldn't be a skip, and it would be a non-taxable transfer between spouses. So there could be some.
Is this the famous Anna Nicole Smith case?
Yeah, yeah, that's right. That's right. Yeah, she was substantially younger than Mr. Smith.
And then I think after she received the estate or gift, the children were fighting them in court. She dies, and her estate goes to her daughter, who is biologically her boyfriend.
Yeah.
It's a mess.
Yeah. And then her attorney was involved too, and he was arguing that because everybody was angling to be that child's parent, because
Correct.
they would be appointed a guardian of the parent, and they would have access to all this money, because the daughter was a baby at the time when she died. She was very, very young.
I think she was 3.
Yeah, you're right. So the other transfers too that add a level of complexity to this are gifts and trust. And a gift and trust could be considered a direct skip, where the grantor, the settlor, contributes or gifts money into a trust, and you have grandchildren and lower level descendants who are beneficiaries of that trust. So because only grandchildren are beneficiaries of that trust, this trust would be considered a skip trust. and that would be a direct skip, because there's no beneficiaries from the first generation that could benefit, that could get any distributions from the trust. Now, if you have a trust that has both children and grandchildren as beneficiaries, for example, you could have a trust where the child, son gets income for life, and then at son's death, grandchildren get the remainder. That is not a direct skip trust. It could be an indirect skip, but not until the death of the son, who is the first generation beneficiary.
So questions there, trust is generally speaking a private matter, right?
Mm-hmm.
And how would anybody find out that there is a direct skip? Unless somebody dispute or contest.
Yeah, the way that these come up is when the gift is made. Let's take my immediately previous example where a settlor creates a trust, funds it with some marketable securities, and the son is the income beneficiary of the trust, and the grandchildren are remainder beneficiaries. So in that case, when the assets are transferred into the trust, that is considered a gift. But because the first generation is the income beneficiary, we don't have a skip yet. There's no skip. G1 has to file a gift tax return to report the gift. And because this is a split gift where we have a present interest, the income going to the son and the remainder going to the grandchildren, only part of this gift qualifies for the $15,000 annual exclusion. That's one point that would get reported on the form 709, the gift tax return. The other one is the allocation of the GST exemption, and also the gift tax exemption too. If G1 wants to allocate the gift tax exemption, it would be done on a gift tax return, both for the present interest gift and also for the remainder gift and the skip gift, the generation skipping transfer. So by filing the gift tax return, by having the settlor comply with his gift tax returning filing requirements, this information would come to the attention of the Internal Revenue Service by filing of this Form 709. And the reason why filing the Form 709 is important is because it triggers the statute of limitations. And if no return is filed, then in theory, the IRS has an unlimited period of time to audit these transactions and impose penalties and interest on, if there's obviously, if there are tax liabilities due. The other way that would come up, you're right, is when there's litigation. And I've heard that even in state court cases, which is, the IRS is a federal agency, as we all know, it's at the federal level. Even litigation in state courts where these types of matters would be heard because they're probate and inheritance related, so they would be heard in state court. State court judges have reported information to the Internal Revenue Service and in cases that are before them. So that's another way that information could could make its way to government agencies. I don't believe, let's see, there might be other ways that information, if they're famous or infamous people and they're being written about in major newspapers like the Wall Street Journal, the Washington Post, Bloomberg News, etc., by investigative reporters who dig in the public records, interview people, and write these interesting articles, government agents are reading those articles, and I don't know, I don't have direct evidence, but I have to assume that a lot of audits have been opened as a result of articles that have been written in some of these major newspapers.
That's why we Chinese always tell people, do not let people know you're wealthy.
Well, there's also the superstitious aspect too, that you know,
Right.
you don't want to boast about your wealth
Right.
because there's issues that it might go away because somebody could send negative thoughts your way.
That's true.
Yeah. Let's look at a calculation of the generation skipping transfer tax and see how terrible and punishing it is. So we have a grandfather who gifts $2 million to his grandson. And let's look at the tax. Now here we have to assume that grandpa does not have his 11.58 million, the estate and gift tax 11.58, and he does not have his generation skipping transfer exemption either. So he's used up both of them. He doesn't have any available to shelter the $2 million, both on the gift tax side or on the GST tax side. So the $2 million is going to be taxed both ways. So the $2 million is taxed at the GST level first, so the tax is $800,000. Then the $800,000 is added to the $2 million, the $2.8 million. And the tax on that is 1.0658, and you have to excuse the calculation there. 2.8 times 40% is not 1.0658, and the reason why is the tax table, the gift tax, the estate and gift tax 40% rate is not a flat tax like the GST. There's a tax table, and the tax rate is a little bit lower at lower levels. For that reason, the gift tax on 2.8 million is a little bit lower than it would be at 40% because you're taking advantage of the lower rates. And that's the 1.0658. So that's the gift tax. We add to it the GST. So the total tax would be 1.868, which is almost equal to the gift itself, if you notice. So to make this gift, grandfather has to spend $3.9 million to give his grandson $2 million. It's very, very expensive and very onerous. And this is why a lot of wealthy individuals plan very well to take advantage of both the applicable exclusion amount, the 11.58 million for gift taxes, and also the GST exclusion of 11.8, so that no gift or GST taxes are due on the transfers. Now,
so I have a question. Okay, so obviously this is not the right way of doing this.
correct.
But, and this is probably why sometimes the foundations were established for a variety of reasons. So let's say if a G1 establish a private foundation. I don't want to get into the charitable side, but establish a foundation, some money was transferred in there. And then within that basically an organization, then G2, G3, G4, a lot of time G3, G4 are involved in the foundation for some work. There potentially could have stipulation there that the G3 and G4 could work for the foundation and still get some money out of it. May not be a lot, but it definitely beats to pay this much.
Yes.
For the purpose of the transfer. Yes,
it is possible to have family members working for the private foundation. The compensation received has to be commensurate with the amount of work that they're putting in.
Right.
And then number two, there's some relationship rules that have to be followed where, particularly in California, certain private foundations, insiders, individuals related to the founders who are getting paid cannot make up more than 50% of the board. There's some state law rules that put some limitations on board members that can get paid.
Right.
Of course, a family member can be an employee and not a board member. Yeah.
I think that sometimes that's why larger family foundation, if you will, they rotate their family member either through the board or employees. So they kind of rotate that around.
Yeah.
Just to avoid these kind of craziness, if you will.
Yeah. The other one, since we're on the topic of private foundations too, another thing that I've read and heard about in recent years, in the last 5, 8, 10 years or so, is a lot of that first generation, the G1 generation, the grandfather's generation, had set up these private foundations a long time ago, and they were involved and the children are involved. Now that the second generation, the grandchildren, they're not involved and they're not interested in being involved in the foundations. So there's a trend of closing or shutting down certain private foundations because the future generation is not interested in running it or is not interested in being involved or staying involved in it. Yeah. One comment that you see in quotes at the bottom of this email on the $2 million that we did not take into account to make the math a little bit easier and more straightforward is the 15,000 annual exclusion. On that 2 million, because grandfather is giving 2 million cash to grandson, the 15,000 comes into play. So our gift would be 1.985 instead of 2 in this example. But just so that the calculation is a little bit easier, I just use 2 million with that taking into account the 15K. We're almost out of time, so let's spend a few minutes on the indirect skips. And I get this email from Walters Kluwer that every week they analyze revenue rulings that have come out from the IRS. And this is an area that I see so every week there's a handful of rulings regarding the generation skipping transfer as it relates to trusts where the exemption, the 11.58 million exemption or whatever it was when the trust was created, was either automatically allocated to the trust and they didn't want to have automatic allocation, or it was not automatically allocated and they should have allocated it. And as a result, they had to spend a lot of money in accounting and legal fees that go back to the IRS and get a ruling to correct things or change things around. So accountants and lawyers are falling into traps as it relates to gifts and trusts that are subject to this GST. So how does this
mean that you can retroact it? These exemption amount? Is that what you're referring to?
Retroactive if there's a reasonable cause.
Okay, got it.
Yeah. Not there has to be some reasonable cause. For example, accountant error, mistakes made by the attorney or the advisors, not the change,
not
the change of mind.
Itself,
yeah, exactly.
Mm-hmm.
Exactly. So with respect to the trusts, if the point I want to make, and this is probably the most important point with respect to gifts and trust, is this dual beneficiary generation within the trust, where you have gifts made in trust, where you have beneficiaries of the first generation, the children generation, and grandchildren generation beneficiaries, where when gifts are made, the GST, if there's potential that there's going to be a generation skipping transfer, and that potential is available at the time the gift is made in trust, then the GST exemption, the 11.58 exemption, with respect to the potential GST transfers, are automatic. And a gift tax return still needs to be filed to take advantage of the $15,000, for example, for the present interest gift. For remainder beneficiaries, in certain circumstances, the $15,000 doesn't apply. If the remainders are not going to get, because it's a future, number one, it's a future interest, it wouldn't apply. And it is this generation skipping transfer exemption allocation is very important, because if there's available allocation to be made, and if it's allocated to this trust, when the child dies, when the first generation beneficiary dies and distributions are made to the grandchildren, there's no GST taxes to be paid. But if there's no GST available to be allocated to the gift, or there's no GST exemption that was automatically allocated, then when distributions are made to the grandchildren, those distributions carry with them GST taxes. So by adding a child as an income beneficiary in a trust, the GST tax payment gets delayed until the time when the child dies, and the remainder beneficiaries step up and become actual current beneficiaries of that trust. And
so this is more of from a drafting that legal document perspective, to keep in mind of the implication of a G2 as a income trust, and then potentially G3 is a remainder. So it's more of the language of the trust taking into the consideration of these potential allocation, if you will.
Yes. Yeah. And sometimes it's not clear in the trust. There's some language in the trust that says, and I've seen this in a revocable life insurance trust where the trust purchased a life insurance policy, and at the death of the settlor, the life insurance death benefit is going to be paid directly into the trust, and the trustee is going to distribute this death benefit to the children of this of the settlor, the insured. Some language is included in the trust document that says if one of the children of the insured settlor predeceases the settlor, their share goes to their children.
So that would be a skip then.
That's right. That's right. So there's potential. There's a potential for a skip there.
So do you then allocate that at the time of the trust was established, when insurance was purchased, or?
I believe that in that situation, it would have been automatically allocated because there would have been a potential
Okay, so because
of a future transfer. Yes.
So when the ILIT was set up, the 709 was filed, and then it was an automatic allocation there.
Well, there were periodic gifts that were made into the trust to pay for the life insurance premiums. Yeah. Mm-hmm. And I know we're kind of digressing here into the ILIT arena and the crummy powers and the 5 and 5 powers, but in order to give this the 15,000 annual exclusion, the beneficiaries have to have this crummy power.
Correct.
And they have to be notified that the funds are in the trust.
So really, in reality, the ILIT, the design of what you're saying, is really taking into the consideration of the flow of the allocation, the flow of going to G2 as an income, sort of an income beneficiary, as well as the G3 as a remainder of the beneficiary.
Correct.
Okay.
Correct.
That makes sense.
There is a mismatch there in the ILIT, and I have to think through this a little bit because the crummy power takes care of the 15,000 annual exclusion for the gift, but it does not take into account the $15,000 for the GST.
Correct.
Because it's a future interest, and
it's not a present. Yeah.
It's a future interest, and perhaps the automatic allocation takes care of that.
Okay.
Where if the automatic exclusion takes care of that, then there wouldn't be any return filing requirement, or if it doesn't, then return would have to be filed, and the automatic allocation box has to be checked on that return.
Okay.
Yeah. Should I continue? I have one last slide.
Yeah,
I think
let's finish your last slide if you don't mind.
Okay. No problem. So we have some general discussion points about family transfers, etc., which is a very interesting area. And the as I mentioned, I think it was last week. This is a very important point that is worth mentioning again, which is the 11.58 million that we have now. That's going to revert back to 5 million, but it's possible that it could go back down at any point in time between now and the end of 2025. So the point I'm trying to make here in this first bullet is that even if we have clients or individuals that we're advising who have a net worth, let's say a family, a couple that has net worth that's smaller than 22 million, let's say it's between 10 and 20 million. So they're less than the 11.58 times 2 or the 22. We still have to be cognizant that that 22 is for sure going away in 2026, but could be reduced dramatically and could place these individuals in an estate tax situation sooner than 2026. And that would apply for individuals who have net worth of 8, 9, 10, and higher. Couple of questions regarding business owners. For business owners who want to transfer shares to their children with appreciated property. The most effective, at least one of the most effective ways to do it would be via discounts. The minority discount and the lack of marketability discount. The minority discount is for a discount because the individual owner of the shares of stock in the corporation or the partnership interest or the limited liability company membership interest in the entity does not have enough power to force the management to do things. The lack of marketability discount is typical for private companies where it would be difficult to sell in the market, and as a result of market pressures, there would be a discount because it wouldn't be as easy as going to a securities exchange and selling that position. So, and how aggressive one is, or their advisor, of course, business valuation folks specialize in this area. For business valuation, then there's appraisals for real estate type assets. Depends on how aggressive they can be in reducing the value of certain of these shares, and using these discounts, it would be more estate and gift tax efficient to gift some of these shares to family members. And by putting some restrictions on voting of these shares, control could be retained by the founder or the parent that owns the business. The idea is not to die with the asset, not owning an asset, and a share of stock or a partnership interest is an asset. So long as the asset has been transferred to a family member, to a child, or a niece or a nephew, or it could be a trusted employee as well. That's always a possibility. Not very common, but that's always a consideration. That helps in reducing and depleting value out of the decedent's estate. The other similar option to that planning idea is to put the assets in a family limited partnership and then transfer partnership interests to family members. Same concepts apply with the discounts, the marketability and control discount. And in that case, interests are being transferred, but instead of being interests, shares of stock in the operating business itself, the partnership could include not only the operating business, but it could also include a portfolio of securities. It could include a portfolio of real estate, commercial real estate asset. It could include different types of investments. And the family limited partnership, or which is similar to the LLC, both would work the same way. Creates a vehicle to contribute these different baskets of assets into the entity. But the same discounts would apply when transferring interest in this family limited partnership to family members. And in this case, filing gift tax returns is very important, because even if the discounts bring the value, the fair market value of the shares or the partnership interest that the individual is going to donate to below $15,000. Filing a gift tax return puts the government on notice that these gifts have been made, and the discounts, the positions, the discounts have been taken to start the clock on the statute of limitations, so that the IRS has a limited period of time to come and audit the discount. And I have to say that the IRS does not like this. They feel that taxpayers have been abusing these planning opportunities. Not all, some have been abusive, not all, but the IRS looks at all of these with an eye that the taxpayers are bad and they're abusing these options, these planning opportunities. Any questions on? There's some other ideas also with life insurance, where buy-sell agreements are entered into during life. Well, where somebody dies, life insurance is acquired on the life of the decedent, and that is paid into the to the surviving owners or surviving partners, and those the surviving partners who want to continue the business use that cash, use the proceeds from the death benefit of the policy to acquire the shares of stock in the business from the decedent's estate. There's self-canceling installment note. There's a few other kind of sophisticated planning opportunities available to get assets out of an estate. And I think all those planning opportunities are going to come back, and they're going to be much more relevant after 2026, for sure after 2026, and perhaps a little sooner if the exclusion amounts are reduced.
When I wrote that questions, I was more focusing on this. So instead of treating it as a gift, and if we use annuity installment sales, and because it's such a low interest rate today, so instead of using it as a gift, I'm actually using it as a sales transfer. And it's still very attractive rate to get them out of the estate, pretty much. And the buyer could be the children or grandchildren that that could take advantage of this low interest rate environment.
Yeah. So that transfers. Okay. So that option there, was your thinking a sale of, let's say, a partnership interest to a child at fair market at fair market value?
At fair market value, taking into the discount, taking into the AFR, and usually those annuity sales, or basically just annuity installment, if you will, that is using the AFR rate and not claiming that as a gift.
Yes, and the benefit of that is the following. If it's an installment sale, and if all of the installment payments have not been made before the decedent dies, that installment note, the note receivable that they took back, the paper that the seller took back, that has value and it would be included in the estate. But the self-canceling installment note it gets canceled upon death of the owner. So nothing is included in the estate. For that reason, the self-canceling installment note may be preferred to an outright installment sale, especially if there's a chance that the founder owner is not in good health and may not survive the term of the note.
Yeah.
If it's a long-term note of 5 or 8 years or 4 years.
I was actually thinking about this one instead, because it was a younger, the age was 35.
Yes.
And it's a highly appreciated company where they started out with nothing. It's a gaming company, and they're worth about $100 million today.
Uh-huh.
And so,
and this individual owns 100% of it?
No, he actually owns 50% of it with a non-relative, a non-blood partner, if you will.
Okay.
And both of them enter into this type of agreement, so that they can transfer at least a portion of their assets outside of the estate, taking this into the consideration.
Yes. The other option would be to consider a grantor retained annuity trust.
Right.
Where, and I don't know if this person has family members, a GRAT, where this person has family members. If I assume that this company has appreciated, but if there's potential for additional appreciation, some of that appreciation could be frozen and trapped in the GRAT. Right. So that it's transferred to the second generation. But at 35, does this person have family, children, etc.?
Well, yes, he does. And what happened was the design was proposed primarily because there was a potential merger and acquisition.
Yeah.
And the potential price was $200 million.
Yeah.
So they wanted to draft something before anything is being considered.
Yeah.
And so that's why this comes into very, very important factor as a consideration.
Right. So in this specific example, who would the seller be selling the asset to?
I think the design idea was to put them into a trust first. So the trust so they were actually transferred into the grantor trust first.
Yes.
Then after the sales, then it's in the trust. It's not individually owned.
And a grantor retained annuity trust?
Yeah.
Okay. And then the assets, the corpus, if you will, if it was sold for 200 million and each partner got 100 million, that 100 million would be invested in the trust, and the grantor would get their annuity.
Correct.
For a period of time, and then that the 100 million is invested, and then over the next 30, 40 years, it grows to say 500 million, and then that whole appreciation over on top of 100 million would escape estate taxes.
That's right. Yeah.
Yeah. Yeah. Yeah, that's an interesting, it would work. It has to be drafted properly.
Yeah, it was. I haven't actually seen the legal document yet, but
Right.
It's actually quite, I think is the business itself is exciting. It's not necessarily the trust itself.
Yeah. Yeah.
Because the business itself has such a potential.
Yeah.
Yeah.
In regards to equalizing the interests, the third bullet point here, if the business owner has other assets outside of the business, those could be used to take care of the daughter, and the business could be left to the son. That's one option.
Yeah, so this is actually my client case where where the business itself happened to operated within that real estate, which is LLC. And so the son will take over the business, and then to equalize it, my recommendation was the daughter would take over the real estate. It just happened to be the value are very similar. And if the son doesn't run the business well, she still have the right to rent out the entire real estate property to someone else. So in case if he runs the company down to the ground, she still have something that she have control over.
Yeah. Yeah. So the operating entity, the LLC, is 100% tenant and user of the real estate. There's no outside.
Yeah, there's no outside.
No outside. Yeah.
There are some minor tenants, but not major. Yeah.
Yeah. From an economic perspective, it's a little risky proposition.
Yeah, the family dynamic is really interesting behind the story, but in that situation, it works for them in that situation.
Yeah. Yeah. There's always planning opportunities too, where the real estate can be sold or exchanged to other real estate, etc.
Right.
To diversify.
Right.
Yeah.
Right.
Yeah, that's a good idea if they're kind of an equal. Of course, a parent does not have to give the same amount to each child. They could, an estate doesn't have to be split 50-50 between two children, or 1/3, 1/3, 1/3 between three children. There's no rule that says that each child should get the exact same amount as their sibling. The parents can give, can allocate their assets in whatever way they want.
I think the traditional planning techniques typically would just bring the life insurance into the discussion, right? And so for the child who is inheriting the business, the other child who is not in the business tend to be getting the life insurance proceed as an equalization. But that tends to be a traditional design. But in this case, they are still young. And the son is in the business, the daughter is not. And she's much well off compared to the son. But to protect her interests, that's probably the best solution for this particular family.
Yeah, the life insurance is a factor. for equalization. It also could be a factor to create some liquidity,
Correct.
especially in an islet context, to have it be sitting outside to pay for the estate taxes if some estate taxes were due. Yeah. A lot of interesting planning opportunities out there.
Yeah, if it's used in the right client situation.
Yes, of course, of course. Yeah.
Well, thank you so much.
Oh, you're welcome. You're welcome.
For spending 3 sessions. Very insightful discussion. Also learn a lot about different client situation. Hoseann and Anne, do you guys have any additional questions?
No, I don't. Anne, how about you?
No, thank you. I was enjoying listening to the discussion.
Yeah, thank you so much, Haraj.
You're welcome.
For sharing your experience with clients and with these techniques. Thank you.
Yes. Thank you very much.
Thank you. Have a good night, and
thank you. Have a great night.
Hopefully we'll see you at some point soon on campus.
We hope so. Yes.
Hopefully.
Yeah, maybe not until August, September, but hopefully in
Soon.
August and September. Yeah, yeah.
Soon. Well, thank you so much for your time, and thank you everyone for attending. All of these recording sessions will be available soon. We have the previous week's recording. We're just waiting for our graduate assistants to write up the content. So we'll make available on our blog website.
Great.
All
Thank
right.
you.
Thank
Good
you.
night.
And take care. Good
Thank
night.
you. Have a good
Bye-bye.
night, everybody. Thanks.
Bye.